Cathy Wood, the renowned founder and CEO of Ark Invest, sells her huge position in Tesla and basically all of Nvidia stock positions. Not to mention that Nvidia was sold right before their huge 30% plus run. Let's look into why she is shifting her funds into this audacious investment strategy that involves acquiring control of these three much smaller cap tech companies. Of course, they are companies in the technology sector. Ark Invest is always after the latest and greatest in technological hardware, aka Nvidia and Tesla, to data and software, which could be the latest shift in focus for the active portfolio manager. There is definitely something her and her team of analysts know to be making moves into much smaller and underperforming stocks. Stay tuned to see what those three are and if they would make a good fit for your portfolio, as they could be coming in due for their bull run. You never want to catch a falling knife, but we might be at the bottom and her ETFs are swooping up all the cheap entry prices. Now, before we get all caught up, a quick heads up, these companies Ark Invest is into right now are kind of in a rough patch. But hold up, don't go rushing to buy just because they're buying. It's not that simple. We're here to break things down and give you the scoop. Ark Invest's latest shopping spree includes three names that might sound familiar. But remember, just because they're buying doesn't mean you should follow suit. We're all about informed decisions here. As we go through this, I'll give you the lowdown on each company, what they've been up to lately, and we'll even throw in some graphs for good measure. And hey, by the end of it, you'll have all the info you need to form your own opinion. Share your thoughts with us down in the comments. Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys. Also, if you guys sign up, the commission will help us stay alive, the channel that is. Alright, let's get back to it. Alright, let's break down what Ark Invest has been up to with their ETFs. They've been doing some buying and selling, and we're here to give you the scoop. So, they've got different ETFs. In RK, they bought stocks like PagerDuty, Twilio, Zoom, and more. In ARKW, they added Pure Storage and others, while in ARKG, they got into Teladoc and more. And in ARKF, they made moves with Twilio and Teladoc. Now, let's focus on Teladoc. It used to be a star player in Ark's ETFs, but lately, its stock hasn't moved much compared to others in their portfolio. So, they've been reducing their stake, not because they've lost faith, but because of the stock's performance. Teladoc's recent stats show it hasn't had much action. Over the past year, it's up just over 5%, but down around 14% in the last 12 months. It's got a market cap of around $4 billion, and while revenue's been growing, things like return on equity and gross profit margin still need some improvement. Looking at a graph, you'll see Teladoc's price is below its 200-day moving average. It's kind of hanging between the 20 and 50-day averages, not showing strong upward movement. The RSI and MACD indicators suggest it's pretty neutral at the moment. Basically, Wall Street's waiting to see how the next quarterly earnings report goes before making up their minds. So, that's the deal with Teladoc. It's had its moments, but right now, it's in a bit of a wait-and-see phase. Now, moving on to company number 2. Twilio. Twilio's story is interesting. Over the past few years, their revenue has been on the rise, but the stock had a bit of a roller coaster ride, especially with the pandemic aftermath. Their revenue growth in the last 12 months has been steady, but not as explosive as before. Their free cash flow direction hasn't been great, and return on equity is still negative. The gross profit margin has been going down too. They've been managing their shares outstanding by using share buyback programs. In terms of stock performance, here's the scoop: it's up 38% year to date, about 5% in the last 3 months, but down 14% from the previous year. Currently, its market cap is around $12.44 billion. Let's talk about the highlights from Twilio's last quarter. Revenue grew by 15%, both in terms of organic revenue and application revenue. Data and application revenue, which is a significant part of their business, grew by 19%, a bit less than the 25% they've achieved before. Communications revenue, another crucial aspect, grew by 14%. The operating margin is around 10%, and their business expansion rate has been decreasing every quarter, currently at 106%. Now, Twilio's situation has a lot to do with their clients and the overall economic environment. It's a bit of a complex puzzle. Let's talk about the kinds of clients Twilio deals with. Some of these clients are cutting back on their spending, and this is hitting Twilio directly. It's like a double whammy: when the market improves, spending might pick up again, but it's also possible that some clients might either go out of business or choose another option. The guidance Twilio provided wasn't too optimistic either, which caused the stock to drop after their earnings report. But interestingly, since then, the stock has climbed up by nearly 50%. It's interesting to note that around $45 seems to be a strong support line for the stock. While it's uncertain if the stock will drop to that point again, it's good to have it in mind for reference. Currently, the stock is not too far from its 200-day moving average. It's above the 20 and 50-day averages. The RSI, which indicates stock strength, is in a neutral zone, and the MACD, which shows stock momentum, is bullish but still below zero. If Twilio has a positive earnings report, it might continue its upward trend. In Ark Invest's portfolio, Twilio now holds the 12th position across all their ETFs combined. Just like Teladoc, Twilio was previously much higher in the ranks. And if you're curious about who's dominating the top 5 positions, it's Tesla, UiPath, Roku, Zoom, and Square. Let's delve into the third company on Ark Invest's radar, which is PagerDuty. I might have discussed this company only once on this channel, a long while back, probably around 2 years ago. PagerDuty is in a similar boat, with a story similar to the others. Its revenue has been on the rise over the last few years, and its cash flow over the last year is showing some improvement too, which is a positive sign. However, its return equity is still in the red, around 43%. Gross profit margins, which were around 80%, have taken a small dip, now hovering around 81 to 82%. Presently, PagerDuty's stock isn't having the best time. It's down about 15.66%, making it the weakest performer among these 3 companies. In the last 3 months, it's down nearly 30%, and in the past year, it's basically remained flat, down by just 1%. The company's market cap is around $2 billion, which might make it interesting for those looking for potentially big returns in the future if PagerDuty can continue to execute well and thrive. Looking at the stock chart, things don't look too great. There was a resistance point around $35 back in April and 2022, and since then, it's been on a downward trend. It even reported earnings on June 1st, which made the downward movement more pronounced. Right now, it's getting closer to a previous support line at around $20. The Relative Strength Index, RSI, is not indicating an oversold condition, and the Moving Average Convergence Divergence, MACD, is currently signaling bearish sentiment. So, what's the story behind PagerDuty? Its revenue has shown a 21% year-over-year increase, and the dollar-based net retention rate is at 116%. The operating cash flow margin stands at 21%. There's growth in customers spending over $100,000, with a 17% increase. Paid customers at 15,000 and free and paid customers combined saw a 19% year-over-year growth. However, here comes the twist. When they reported their earnings, the shares dropped by about 17%, even though their revenue exceeded expectations. The issue was with the guidance provided. The company cut its full-year revenue guidance due to ongoing macro challenges that are extending sales cycles and limiting seat expansion. Ark Invest comments on this by saying that despite the drop, they believe PagerDuty, with its AI adoption and proprietary data, is well positioned to benefit from the trend of increased demand for automated incident support software. As for its position in Ark Invest's combined holdings, PagerDuty is around the 20th position, nestled between Beam Therapeutics and VeriSight. They hold 2 positions between $25 to $29. Keep an eye on how PagerDuty's story unfolds in the coming times as well as the broader market trends. In a nutshell, Ark Invest operates as an active ETF. When one of their investments is doing well, they tend to take profits from it and reinvest those profits into other positions that might not be performing as strongly. This seems to be the case with companies like Twilio, PagerDuty, and Teladoc, where their stocks haven't shown much movement compared to the other holdings they sold. However, this doesn't necessarily mean that Ark Invest has lost faith in the companies they sold. It's more about their active strategy to lower the average cost of the underperforming stocks. If you do hold any of these 3 companies, it's interesting to consider Ark Invest's perspective. Do you agree with their approach of buying more in the current situation? Or do you think it might be a better idea to sell and explore other opportunities? The investment world is always evolving, and the right move for you depends on your individual goals and risk tolerance.